bought a stock market too quickly.
Yeah, it was one day for Uber.
Yeah.
Oh,
Did
get
it drop
this.
big today?
It dropped big for several days.
Lamb Weston's spokesperson came out yesterday and they spoke on McDonald's 4 for 4 or some deal. And apparently McDonald's makes up 13% of all sales for Lamb Weston. Domino's, I don't know how Domino's gets sales, but Domino's is a part of them. And they mentioned like 3 other companies, so now I know. I'm going to look for their deals menus on.
What is Uber considered? What kind of industry is that?
Huh?
What kind of industry would Uber be in?
Apparently.
Industrial?
Some pizza company. It was Domino's Pizza.
I don't know.
I feel like it can't be industrial.
Dude.
That feels weird. And why are their competitors DoorDash?
Do this. So in FactSet, go to the screen, pull up this NEICS lookup,
And CSI with
and I don't know if Uber's going to show. Let's see.
Oh, I don't have that. How did you get to there?
It should be it should be available for you guys.
I don't have it. Mine says ETF, valuation, screening tool, mine, and then Sandin's version.
In the client folder,
Mm-hmm.
you don't have.
I don't know. Can you show me how to
Yeah. So go in here. These are just recent.
Oh,
So
okay.
go in there, and inside the client folder, it should show up.
Comps?
You can't breathe in the sauce.
Hit the client folder again.
Can't breathe in this.
There you go.
Oh, okay.
It just wasn't pulling.
Oh.
It just rolled me quick,
And-
completely, so it didn't pull it up.
NAIC?
So you always get chow mein?
Yeah.
Like when you
So
go?
if you
That's
click
the only
on,
thing I have.
I don't know.
if you bring that up,
Just something I observed.
and let's see. This is the look at their code for when we use IBIS World later.
Oh, that's the IBIS World?
Yeah, but Uber. 1352. Ground transportation, industrials,
Huh.
That's useful.
That's interesting.
and that should be able to get you the reference number in IBIS World to see
Okay.
what the competitive position is.
Cool. United Airlines was a really good stock. I know that money after. They've been going up for a long time. Like the last week. If we have industrial? Everything's covered in here, right?
Yeah, but Uber just announced a potential acquisition, so that may be what they're following.
Expedia.
Yeah.
Their earnings estimates didn't look great though, so I'm also wondering if that's.
Got everybody? Okay. So let's see. So this week, the next couple of oh, by the way, so I don't forget it, we've got today's the 17th. We've got a visitor for not the entire class. I don't know how long, maybe 20 minutes. Next Thursday.
Oh,
Are we doing anything next Thursday?
Yeah. We will. She'll be in here for, I guess, the start of class, and then we'll just carry on like normal afterwards. It's someone from Hilltop Securities, I think is the name of it, in Dallas.
Okay.
So they wanted to come by here, they're talking some other classes, or maybe it's the College of Business overall. But she wanted to see about coming in here and talking with us. I'm not really certain about what. She's not an analyst with them. She works in, you could say, the back office, which means where they clear trades and stuff like that. Right? So you guys always think about the front part where you've got the brokers, the analysts, all those people. She's more in the, I hate to say the administrative function, but she's more in that area where she's worried about making certain that the trades go through right, all that kind of stuff. We've had some people come out of Roundtable in the past who've actually gone down that route where they're working, the clearing function in other parts in the finance area. So it might be it's a little bit different. It'd be something interesting for you guys to hear about. We'll talk a little bit more about that during attribution next Tuesday. But she's here for at least a little bit of the time a week from today. Okay? Let's see. So today, next Thursday, and then the 2 or 3 Thursdays after that, we're going to do nothing but get you guys geared up for. So let me back up real quick. So when Trent and then all of you guys are presenting in about a month and a half from now, your stock selections, Trent will present the current 4 that we're in communication services, or for Sandon, the current 2 that we are in real estate, right? So what you have, and then an equal number of prospective stocks. So if you've got, like Vincent's, how many do we have? 5? So you've got the worst job because you've got the 5 we've got plus 5 potential. The idea is we could keep the 5 we got, we could keep the ones we have, we could completely turn them all over and get brand new stocks, or some mix, right? So we want that possibility. And what that means is you want to research the companies you have, but you also want to go out and find out what are the best companies in your sector that we're not investing in. And that's what we're trying to move towards now, right? So we're going to hit a number of things. We're going to see, this is probably the topic we're going to do today is the one that's, that's why I've got Colby up here, video recording this thing for you guys. He'll dump it on like he did the other one so you can look over it.
I'll probably post it in the Facebook, just a link or something.
And we'll see how far we can get. We may not get all the way through this one today. So if we don't, we'll pick it up next Thursday and finish it up. But what we're going to do today is the following. Let me go into here real quick first. So I did this, and I kind of got a bit ahead of myself about a month ago doing this when I was thinking of the stock selection instead of the sectors like we're moving into. So we're still going to use relative valuation like we've been, or you guys will be, like you have been, like you did with your sectors. But now you'll do it across individual stocks, okay? Now, you could go and you could compare like the PE ratios of each company in your sector, and and then look at their profitability, their risk, and their growth. But you're going to have so much data to look at, it's inefficient. And so what we found is a better approach is to use regression analysis, right? So the basic, oops, what did I just do? So the basic idea is that you want to go and find low PEs if that's the metric that we're using. But you also need to be aware that a company's PE could be, for example, high because they have high profitability, or because they're growing fast, or because they have low levels of risk, right? So we've got profit is a dimension to be considerate of, so is growth, and so is risk. And right down here, so what we're going to need is the following. We're going to need for each company, that's what these are, the I's. We're going to need to get some data. So for each company, we're going to need to have, if we use PE, again, we may not use PE, but just as an example, we might have, say, company number 1. They've got a PE of 20. We want to know, like maybe for profit, say that we use the net profit margin as an example. So we want the net profit margin for them. Let's say it's 5%. Growth, let's say PE. So let's say we have earnings per share growth, right? So EPS growth. And let's say the expected growth for this company is 25%. And then risk, say we use beta. So we get the beta for this company, and it's 1.2, right? And then we keep doing this for a whole bunch of companies. So the next company has a PE of 8. Their profitability is only 3%. They're only growing at 12%, and their beta is, say, 1.5. We could keep doing this for however many companies we have. Let's say we've got 1,500 companies in our list, right? So we will have a pretty large table once we're done with this, and it's not something we can go through row by row and look at. So we're going to have Excel help us out, right? So the PE right here will be our dependent variable, or our Y variable over here. And these other 3 columns right here, profit, growth, and risk, will be our 3 X or independent variables over here. And the basic premise is that we should find a predictable relationship that is statistically significant between our Y variable and these 3 X or independent variables. What kind of relationship? Well, if high profit should lead to a high PE ratio, we should expect to see a coefficient sign from our regression results that's positive on that coefficient. And we get our regression results. If growth has a positive impact on PE, high growth firms have a higher PE, which we think that sounds reasonable. We should see a positive coefficient on growth. And then finally, higher risk, we should see lower prices and lower price to earnings ratios. So that coefficient should be negative in sign, right? So we're going to collect data. We're going to run a regression. We're going to check the regression results and see if the coefficient signs have the right sign, positive or negative, and if they are significant statistically. And then if they are, we're going to come back and use this data to determine if the company's under or overvalued. So I'll show you that in a bit. So that's kind of a brief overview. Let me go back, I think, so we can see it a bit better. Let's just go back to the other computer. And let me close.
Use price to sales ratio.
Yeah. Just so you guys know what I'm using, because this will take a little bit to load. Inside the client folder, there should be a file that says Valuation Screen Spring 2024. You guys are welcome to go and mess around with this, but what I'd say is, just like you did for the Roundtable portfolio, save a copy to your personal folder and then mess around with it whatever you want to do. Okay? So, let's see. What did we do up here? Put in here. And I did that because I was toying around with it, just testing some things out. Let's see. We've got their sectors, industries, and so forth. You know, I want to know, like, what sector are we looking at here? Because, for example, maybe I just want to look at the utility sector and so forth. And then maybe what industries we're looking at within that sector. So let's see. Here's my PE ratio. I've got a couple different measures of growth up here. And by the way, how do you get data in this thing? If I want to do earnings growth, then I can type in, let's see, EPS growth, just whatever seems to make sense, and it's going to try to anticipate what I'm requesting. And you noticed up here, there are 3 different things that have popped up over on the right-hand side. It's got fact set estimates, so that's forward-looking. That's would be expected growth, right? Maybe for the rest of 2024, 2025, or some period in the future. So when you see estimates, it is exactly that. It's an estimate. So it's usually a forward-looking estimate. Then you get fact set fundamentals, where you see the 3rd item up there. Fundamentals means it's gone back and it's looked at what actually happened in the past. Okay? So fundamentals will be historical growth. Estimates will be expected or anticipated growth. And then you get, we don't tend to use this hardly ever unless we can't avoid it, is where it says fact set global. So almost everything you guys are going to use in here in this analysis will be either the fundamentals, the past data, or the estimates, the expectational data going forward. Okay? So that, and if you're looking for something you're not really certain, like I want a measure of profit, just type in profit and it's going to start throwing some net income margin, so net profit margin, right? That may not be what you're looking for. You might say, I want the operating margin, right? So you can kind of give it clues and it will try to anticipate what you're looking for. So you guys could go in and augment or change this list around and kind of make it your own if you want to. Because what's going to happen in here, there's no constraint that says we need to use the same metric for each of you in here. So you might want to go off and kind of, you might work together, but then you're ultimately going to kind of go off on your own to use the screen and then run the regression to pick out the best securities in your sector. Okay? All right, so let's see. I've got several growth. Let's do this. Let's go, how do I want to do this? Let's just go ahead. There's a number of things I want to show you guys in here, but I've got some other price. I've got PE, I've got price cash flow, price book, price sales, and I've got the profit, growth, and risk data to go with it, okay? There are some things I want to show you guys in here, but you can kind of see where to get it. Go to screening, and then go to the folder, and you will see it in the client folder. For now, let's kind of get out of here. Let's download this into Excel and mess around with it for a bit, okay? So to download this into Excel, just hit over here by the printer icon. It's got the down arrow. Click on that, and it should, there we go, prepare an Excel file, and there we go. Oops, let me save this as something else. I've got that one I just closed, has all my work on it. So it's the download from this with everything done. Well, let's just show you guys what it's going to look like when you download this thing and some of the stuff you're going to want to do to it. Okay, so first thing, make sure you hit enable editing. I find it's kind of, you don't have to do this, but I just get rid of these top 4 rows. I don't need them, they're blank. And then if you notice up here, it's going to cause problems if you leave it in. It's got row 1 and then row 3. Row 2 is hidden. So click on those on rows 1 and 3 and then double click. It'll expose 2. I don't know why that's in there. Get rid of that row. Just delete it out. If you don't, it's going to cause you an error message, very likely when you run a regression. So it's worth getting rid of that thing, okay? Let's see. Let me try this up here. 3 feet away. Works
Net
great.
income margin.
Okay, so just so I can kind of get a sense, I'm gonna just put the cursor just arbitrarily right here. In fact, let's put it over a bit. Well, let's put it there. Go to View, hit Split a couple of times until you see bars going both ways. And I'll show you why I'm doing that. Hit Control End, and it will. You see what it's just done. I've got my first row of data up here, and my last row and column of data over here. So I've got everything in that screen, okay? That'll be kind of important later.
What did you do for that? What did you do?
Let's go back. So it kind of looked like that. I hit the split up here to kind of split the screen, 4 sections, and then in the lower right quadrant, I'm hitting Control and End. And it puts the cursor over on the bottom right.
So you control in?
Control End. And that gives me the entire screen, right? Or at least it gives me the corners of each of those 4 pieces.
It's not
Control end. What
Yeah,
is that?
Control End.
Oh, okay. Alright.
in or
In.
Oh,
In.
Oh,
Now,
crazy.
You're thinking in, right? So
Yeah.
Control End.
I did Control N
Got
and
it
it
now.
opened up another workbook and it
Did
scared
it?
me. Yeah.
Okay. Okay, so here's what I want to do. I want to set this up for my regression, right? So I'm going to kind of color code some things here. Let's make the bright blue. This is going to be my Y variable. So let's say I'm going to use price to sales here. Okay, so I'm going to do price sales. It's going to be my main, instead of PE, I'm just going to use price sales. Okay, we can test some other stuff in a bit. So I'm going to go over and grab all my price sales stuff. Let's see, there's my price sales data, column I. So I'm just going to put a formula, it's just going to grab it. And let's copy that down. I'm just copying it over, right? I'm leaving the price sales column that I've imported in alone. I'm just putting that data over there because that's where my regression inputs are going to be. Okay, that's all I've done. Let me blow this up a bit so you guys can see it better. Does that help a little bit back there?
It does. That's the price sales trailing, right?
Yeah, yeah. And we're just doing this to see. I can't remember if this is what I ended up with or not, but let's just try it with this, okay? So there's price sales. Now, what I want next to it is I want to have my X variables, right? So I'm going to put up here a variable for profit, one for growth, and one for risk. And let's just go with that right now. I've got some other things in here. We'll talk about that later. Let's just make it as basic as possible. And I'm not going to, remember I had, I've got several things for profit. In fact, let's look back at this real quick, just to see what I've got in here. So I've got 3 different measures of sales growth. Okay, I don't want to use all 3. I want to use whichever one gives me the best results. So I'm going to have to eventually find out which one's going to be the best of those 3. I've got several profit measures. I've got operating margin, net profit margin, and ROE. Those are all measures of profitability. All right, so these right here are my profitability ratios. And then I've got some measures of risk up here.
Scroll on all different folders.
For risk, I've got a 5-year beta, 3-year, and then stock price standard deviation. So I've got 3 different measures of risk. Again, I'm not going to use all 3 of these. I want to use one only, but I want the one that works the best in my regression. Okay? So one measure of my growth, of the 3 growth inputs I have, one of my 3 profit measures, one of my 3 risk measures. I'm just going to pick one of each. I'm not going to worry about whether they're the best or not, and just see how to run the basic regression with that. I've got a bunch of other stuff in here too we'll talk about in a bit, or eventually. So let's see, profit. I'm just going to grab the first one that was over here. So the first one was the growth in sales for 2024, right? So that's column J. I'm just going to grab that right there.
What's the growth sales TTM?
Trailing 12 month?
Okay.
Yeah. Yeah, if you ever see that in there, TTM.
Trailing 12 months.
Mm-hmm. I'm going to go, oops, that should have been, that's not that. That should have been what I just grabbed right there.
Could you use the TTM instead of the 2024?
Yeah, it's all a matter of getting the one that works the best in the regression. So we could say in theory what should happen, but sometimes it's an empirical matter which one works the best.
What are you using for growth right there? I'm sorry.
For growth, I just used the first one. It was in column J. So column J had growth in sales for 2024. It was this one right here. So these are both forward-looking growth measures. To give you an idea, this one is forecast growth for this year, which is almost done, but this is 2024 growth. So it's partially what we know and partially what we don't know for the remaining couple of months. This one right here, if I'm not mistaken, or it may be this one. This one right here is forward 12 months. So it's like for the next 12 months, which is a couple of months of this year, and then a lot of months for next year. And then this one is going backwards 12 months. What was the growth over that period of time? So in case you're wondering, why do these both have 2024, but they're different rates? Because one starts now and goes forward 12 months. One is 2024 start to finish, right? That's why they're a bit different.
So for profit, we're using which one?
Say it again.
Which one are we using for profit? Which measure?
Oh no, you have to get the
I'm just going to grab operating margin because it's the first one up there, but it's not going to be the best. It's just, this is just pure illustration right now, and I'm hoping the results aren't good, so that we can see what happens in that case.
It said it shouldn't run the regression because I haven't.
All right, so let's see.
probably.
So let's go grab our
You're selecting the
profit.
Yeah, but I can hit.
I'm just going to use operating
save
margin for that.
labels.
just don't do
And let's
Then
go
how am I
and
gonna
grab
know
a
what
risk
glitch when it
measure.
comes
And
out?
I think the first one was a,
in front of.
in fact, let's do this. I'm going to use the standard deviation, the last one of those. I'm going to use it because I know it doesn't work well. Oops.
Oh, you just labeled that.
Okay, so there's my data, right? So I've got my Y variable, price to sales ratio for each of my companies. I've got profit measure, which I think was the operating margin that I picked, just the first one there. I've got the first of the three growth measures, and I took the standard deviation of stock price, right? The last of the three risk measures. So let's go run a regression with this. So the first thing you need to do, in fact, before you even do that, do the following. Grab this entire area, and if you notice what I've got down here, let's see. Let me check that.
Do you own that phone for that?
Yeah, I just
What is he using for
I was
profit?
just curious.
Okay, so let's
But you,
Wait, how do you grab it without having to scroll all the way down?
Operating.
so
just
controls.
put your cursor on the top,
Okay.
cursor on the top, and then hit, click on the
net.
shift key,
Rough.
Okay.
and then put the ending cell. So starting cell, shift, ending cell, and it grabs the entire block. So, I think we're good. So let's go ahead and run a regression on this. So what you guys are gonna want, click on, in Excel, click on data, and over in the upper right, you should see data analysis. If it's loaded.
That's if they have the tool back.
If it's loaded, yeah. If it's not, you're gonna wanna go into File, down at the bottom to Options.
Profit.
Is yours loaded?
Yes.
Toby? Does everybody have the data analysis pack loaded? You got it, Garen? Vincent? Trent?
Should we?
Whitman, yours
Should
is
we do
what?
only our sector, or should we do the whole market?
Let me remind me in a bit.
Okay.
Remind me in just a bit.
You'll have to pull out your sector.
I'll tell you who's gonna have to pull a sector out separate.
IT.
Ethan, you're gonna need to.
I did that already, so that's convenient.
And possibly Sandon.
But I will have to
Alright,
change it.
The rest of you, yours is a toss-up, but I would say don't do it, and we'll talk about it later. The rest of you, I'd say leave all of yours lumped together. We'll discuss that in a bit,
Okay,
right?
well, I was gonna ask what there were better.
Yeah, because yours, I would say, the basic overall idea is gonna be the same, but you might want to look at some different stuff.
Yeah.
And we can talk about that in here or out of here, so we can do that.
Okay. I don't know if sales support does.
It's one of the problems with financials is they're a bit different
Yeah.
from most of the rest. Let me just move this top bar over so we've got a bit more room here. Okay, so let's do a regression. So I'm gonna hit data analysis, and I want to bring up the regression tool. Click on that. Okay, so here's what we get, right? So my Y range, I'm just gonna click on the up arrow, and now from there I want to go and do like I did before. Click on the first price sales number, hit enter, or should hit shift, not enter, but hit shift, and then click on the last, and it grabs that entire column, and then enter that in. That one's in, okay? Oh, let me go back, sorry, make a change. Click on the first row, where it's got PS, the label, you want the label, and then hit the shift key, and then click the last price sales, and enter that. You want to include the label, okay? So include that in there as well.
Do you have to have labels selected?
Eventually. Make certain that these three columns, your X columns, are all together. There can't be any gaps. They can't be all over the place. They have to be adjacent to each other, okay? So for your X range, click on that arrow, and then come up here and click on profit. So AH1, and then hit shift, and then click on the last item down there for XLE, click on that risk number. All right, and then hit enter. Your data's all in. Now, because I clicked on the top row where it's got my labels, I need to click labels here. All right? And then the next item's personal preference. It defaults to give you the output in a new worksheet. So it'll create a new tab. It'll dump that stuff in a new tab. I like to have it right beside my data, just off a bit. So again, this is pure personal preference. So I kind of do the following. I put the data over here where I can kind of see it next to where I'm going to do the work with it. And there we go.
His
So,
worked perfectly.
what's that?
Sandon's doing
That's
it.
insane.
You got it to work first try. Sandon keeps getting the non-numeric data thing.
Good. We're going to see that in a bit.
Oh, it's because you have it in the table. Take it out of the table. Here.
Oh, I have to take it out of the table.
Oh.
Okay, so I just reduced the number of digits so we can see this a bit better. So let's see what I've got here.
10%.
So intercept, don't worry about that. Profit, growth, and risk. Now what's the first thing I want to see on these?
Profit is positive.
I want to see, here's my coefficients, right? I want to see a positive there, that's good. I want to see a positive for growth, that's good. I want to see a negative for risk, that's not okay. So I know, this is why I picked standard deviation, because I'd already tested it, it didn't work. And I wanted to show you guys. So I know that standard deviation is not going to be workable. I don't want to use a regression that has a coefficient that is the wrong predicted sign, because it'll give me goofy results that won't make any sense, right? Now, let's look at something else over here. P-values is the easiest way that I found to determine statistical significance. I'd like to see something that is, what's the range you guys normally hear of?
Does it convert to range?
5% or better?
Yeah.
Okay, so you want a p-value that is 0.05 or lower.
You can just copy
Right.
and paste the raw data.
0, good. 0.09. You could say that's within 10%, but if I'm looking for 5% or better, like a 95% confidence interval, that one's not going to be good enough, and that's my growth number right there. So while the sign's okay, it's not as significant as I'd like, so I might try a different growth number. And then risk, it's significant, but it's saying that higher risk should lead to a higher PE, which is contrary to what we think in theory. So I want to dump that one, okay? But you see how to do the basic regression and how, you know, what we're looking for in the results. So now that those don't work, let's go back and try something else. You know, I'll show you guys something later. I don't know if we'll get to it today or next Thursday, going back into FactSet that will minimize the number of trial and errors you have to do to find variables that work best, right? So we'll do some of that analysis in FactSet in that screen. So let's go back and let me change a couple of these inputs. Let's see. In fact, I'm going to change them all. I don't need to change profit, but I am. I'm going to go use the net margin. And I'm going to use for growth, I think I'm going to use trailing 12 months. So growth in sales, trailing 12 months. And then for risk, I'm going to use, what am I going to use?
So I'm guessing you don't want the sales coefficient to be negative.
Oh, I used the 5. No, I used the 3.
The sales which
For growth.
coefficient?
Growth. My bad.
Growth
Whoopsies.
coefficient.
Positive. It's got to be
Growth,
positive.
I just used
Otherwise, you're
the,
saying you're penalizing companies that are
yeah.
growing fast.
I
And
believe
then
I
you don't
used the
want
J2.
The risk.
Yeah, I used the J
coefficient
column.
to be
So
positive.
Yeah, so I'm going to use
growth
the
period
5.
on period
I should just
sales
listen to
mean.
you when you said it.
Gotcha.
I know.
So the 5
We did that last.
Was it the same one last time?
Yeah, it was. Because the FactSet chart.
Profit, growth, risk.
Okay, so I've grabbed those. I'm just going to make a copy down. So there's my different input variables.
No idea.
So I've changed the variable, so I've got to go and rerun the regression. All right? Now, I think this may be what you did, Sanders. Let's go rerun this thing, and it's going to give me an error.
It's because you had it as a
Okay.
table.
It's because I had it as a table.
Yeah. The data analysis
Who
toolpack, if
knew?
you have it set as a table,
But there's something else too.
Oh yeah, taken out.
So let's go rerun that, and you'll see input range contains non-numeric data. So this can be an issue that's going to pop up, and let me show you why.
Did you
Is that
highlight the
space?
label or
Whoa,
something?
you took away the space.
So let's see.
I took that out.
I should have too.
Or is there like
Yeah,
there's in there?
It's not that. It's that. Okay, so let me do this. I'm just going to go and grab all this stuff right here. From up here, I'm clicking A1, I hit the shift and clicking down here. So I'm getting all of that table, okay? I'm just going to do sort real quick. And I'm going to sort by the growth value, right? So AI column.
First try.
And you notice what I have down here? I got 2 NAs. So 2 of these companies didn't have growth for it, or didn't have trailing growth. FTRE and NBC, whoever they are. So either I'd have to use a new input or kick these companies out, or go back and find out what their growth actually was and hand compute it and dump it in. I'm just going to kick them out for right now, right? So we're not going to use those 2. So for right now, let's just get rid of these 2 companies. And by the way, notice what I had to do? I clicked from up here all the way down here so I preserve the rows. Don't just sort this because it'll mismatch the companies who data it belongs to. You want to keep each row completely intact all the way through. Let's just get rid of that stuff right there.
I have a question.
Yeah.
Will it give you funky results if you don't? So like if you don't take it out and you just replace the values with 0, will it give you funky results in your regression?
I'd say don't replace it with 0
Uh-huh.
because you're saying it had 0 growth.
Okay.
So to replace it with something, make it a number that is legit
Okay.
on there. So you go back into FactSet for those 2 companies, and you went and found out what their growth actually was, and you put that in there in place of it.
Okay.
Otherwise, you've got 2 choices: take them out, or use a different metric
Okay.
that would include them. Almost any of these, we're going to lose some companies, and it's almost unavoidable. Real quick, if I click on an entire column like price sales, you notice down here it's giving me like average and so forth. It's giving me some data about it, so I know there's no NAs. If I click on, do I have any of that? Okay, so that's where the non-numeric data came from. Let's try this one more time. Except now I've got a problem. I've knocked out 2 of my companies, so I've got to reestablish. Let's see, that should be to 28, I think. And that one.
How come we didn't have any NAs? That's so weird. What? I didn't have any NAs when I did mine.
I had like 19.
No kidding.
I just replaced them with 0.
That's gonna make a difference though.
Yeah.
Okay, so
That
so
makes
after
sense.
changing
Could be
the
an outlier.
inputs, here's what we get now. Let me just clean this up so it's easier to read these numbers.
How did he sort that?
He has a table. No, he didn't.
Okay.
Oh, he used it.
So,
for the future.
profit growth risk, profit's positive, it's significant, that's good. Growth is positive, it's what we want, it's significant.
Make sure you
And then risk is negative, what we're looking for. I get a p-value of 0.022, it's below 0.05, that's good. So I can use this regression right here, right? So let me show you what you're gonna want to do next. Again, this is just kind of a test run. So let's see. What I want to do now is I want to build a column up here, a new one. Let's call this predicted. And since my Y variable is price sales, this is my predicted price to sales ratio, okay? So here's how I'm gonna do this. Let's make life easy here. Let's name, I wanna use these coefficient values right here for intercept, profit, growth, and risk. Okay, so I want these 4 numbers here. So I'm going to name each of these cells and make life to make it workable. So put my cursor in the intercept coefficient, and I'm just going to come up here into this box and type in just intercept. Okay, and then the next one, the coefficient for profit, I'm just going to type in up here profit to name it. So I'm naming each of these coefficients. I'm going to name that one growth. And then the last one, I've got it down in the risk coefficient, and up here, I'm going to type in risk. And here's why that's beneficial, because now I come up here, let's scoot over a bit, equals intercept. So it's going to grab the intercept down there, and then plus profit is grabbing my profit coefficient, but that one I want to multiply by the profit for company 1. Okay? And then I want to type or hit plus growth. That'll grab the growth coefficient out of the regression and multiply that by the growth for company 1. And then lastly, plus risk. So that'll grab the risk coefficient value in the regression and multiply that by the risk measure for company 1. It's all done, hit enter. There's the predicted price to sales ratio for that first company, for EXE, whomever they are, okay? Now, let's go and let's copy that down for all of these companies. There are my predicted price to sales ratios for all of these 1,327 companies that we've got in here. Now, here's the actual price. So for the last one, TGTX, their actual price sales is 10.9. Once you account for that company's profit, growth, and risk, the regression says they should be trading at 1605. Let me blow this up a little bit better so you guys can see it even better. Right, so that's TJTX's actual price sales. Here's what the regression says they should be trading at, given their values for profit, growth, and risk. So let me ask you real quick. TJTX, ignore all the other companies, TJTX, do they is the regression telling us that they are at this price right here? Are they undervalued or overvalued?
Undervalued.
How come?
They have a lower PS than what we predict they should have.
Right. Here's what they're trading at. Here's what it says they should be at. Right? They should be at a higher price of sales than what they're actually trading at. So they're undervalued. The question is by how much, right? So we'll see that in a minute. What about EXE at the top? What do you guys think for it? It's overvalued, right? Because it's trading with a price sales above what's predicted. Now we've got some that are going to be, that we're probably going to we'll have to think about a little bit later, like MXL. It's got a predicted it's negative, right? Which is going to be an issue. Let's just take what we've got there and let's do the following. I want to know if these are over or undervalued. So I'm just going to say, I'm just going to do an O/U, tell me if they're over or undervalued. And to compute this, I want to take my actual price sales, that Y variable, and divide it by what I just predicted from the regression. So the regression output, okay? So the number in column AG divided by the number in column AM. Enter that. Just clean it up a bit so it's easier to read. And let's copy it down. There we go. Now, what I want to do now is I want to sort all this data again. So for the moment, let's just sort this purely by that last column, AN, which is is it over or undervalued? And so this is the column that we're interested in, AN, okay? Don't worry about these real quick. Let's get rid of these guys here. Let's see. I'm gonna make them go away real quick. There we go. We'll talk about the ones that come out negative a little bit later, okay? Pretend they're not there. So right now, that's interesting. It's got a price sales of 0. What actually is it? 0.03. Okay. Okay. So that is a low price sales. So it's trading at a price sales of 0.03. This says it should be trading at 3.29. So basically it's 99% undervalued. It's 99% below where it should be, right? So when it says 0.01, it's that 1% of the value it should be trading at. Down here, PLTR. Is that
Palantir. Yeah.
Is it? So they're saying it's trading at 37.9 price to sales. It should be trading at 3.32. It's trading 11.41. It's 10.41 times higher than it should be trading at if it were fairly priced. Let's look at some that are kind of a bit more reasonable here. There we go.
Where's Costco?
Hmm?
CSCO? No, that's Cisco.
Cisco?
There's some,
Yeah, Cisco. So, so where was Cisco? Right here?
Yeah.
Cisco. So Cisco has a price sales of 4.2, should be 4.1. It's basically, it's
par.
2% overvalued, right? Which is nothing. It's pretty close to being fairly valued. Since I've sorted it from low to high, going this direction, it's more likely I'm going to find undervalued companies, and further down, more likely they're overvalued. So I kind of want to focus on the undervalued companies up here. Now, there's one problem with what I just did. It has, let's see, those are the company names. There's the sectors. It's
No p-values, right?
So what's the problem with what I just did, sorting it that way?
It is useless.
Oh, it's like a bunch of sectors next to each other.
Yeah, you kind of want your sector grouped together, right? Without worrying about everybody else's. So let's do this. Let's go back and resort this again. I'm just going to grab these here. And let's go in here. Let's get rid of that. So the first thing I want to do is I want to sort by the sector column because I want all the sector results together.
How did you highlight them all?
Just I put the cursor there to start,
Mhm.
hit the shift key, and then put the cursor down here in that bottom corner and hit enter. Or well, don't hit enter, hit sort button.
This needs to be negative.
I want to get rid of my headers on this one. So I want to sort by column C that's got sectors in it. It doesn't matter if you do small, large, or large, small on that. So column C, let's just do AZ, and then hit another level. So second level is, because this will group it, that'll group it by sector. And then within each sector, I want to have them sort by this column from small to large. Okay? So I want to sort second by AN over here. There we go. So here's all the communication services companies from what should be the most undervalued by 83%. So basically Scholastic Corporation is trading at 17% of their predicted value. So it's undervalued by 83%. According to this, if we scroll down, let's see, more communication services. So there's the last one of Trent's right there. It's TKO Holdings. They're trading at 243% of their predicted value. So TKO is significantly overvalued. So how am I going to use, let's say that we trusted these results and we're going to go with these results. How am I going to use this? I don't want to simply go and say, okay, I'm doing Trent sector, I'm doing communication services, so I'm going to take these top four, but I might start with this top four and look over them and start reviewing them in fact set. And because remember, there's a number of reasons why the price to sales could be high or low, right? It could be high because they're overvalued or because they've really got good data. And the same thing for a low price sales. They're undervalued or they're really not doing too well. So we've put in profit growth and risk, but there's a lot of other things that could affect them. And that's what you guys are going to have to do some legwork by looking around. So this is a way to orient your search without it being random and to start focusing on companies that appear to be the most undervalued and see if they're worth recommending. Right? This will be the part that will be the most labor intensive of the work that you'll do in here the entire semester. Is once you get the screening and the regression results, to use that to orient your search and your analysis to find which companies would you actually recommend that came in undervalued. It's very possible that the ones that are most undervalued you determine just aren't worth recommending in class, right? But you'll have to do some legwork to find that out. So if these were the final results here, you'd probably start with these guys, start doing the actual work, looking at them company by company. And you might say, no, yes, no, and then kind of take the next three down here and kind of move on down, all right? It's also worth looking on here, like where are existing companies on here? Are they also undervalued or are they overvalued and by how much? All right, so for example,
There's the next arrow right there.
yeah, here's next era. So they've got a price sales of 7.1. It should be 4.78. It says they're 48% overvalued, according to this. That's worth knowing when it gets presented later. All right. So, and you guys will see all of your companies. And in case you're wondering, how did I get 1,300 some odd companies in here? Just to show you real quick, what I started with was not the S&P 500, but the S&P 1500. Because, you know, if you go back about 5 years, we exclusively used the 500. We only invest in those companies. But that kept a lot of companies that you guys hear about
that we never have been investing in. So a lot of new tech companies, things like that, would have been excluded completely. The S&P 500 are the largest 500 companies. There is an S&P 400 that are 400 mid-cap companies. Then S&P 600 are the 600 in the SP index that are the small cap companies. So by market value, right? So 500, 400, 600, that's your 1,500. So you could be investing in, you could recommend companies that are small cap companies that are from the S&P 600 because they're in the 1,500. Or you could be recommending mid cap companies or large cap. All right, they're kind of all fair game in this. Let's see. Why didn't I have 1,500 results? I did a little bit of filtering in here. So we'll look at that in a little bit. Let's see. What other things?
For the over/under, did you divide?
I did AG, the actual
Divided
price
by
sales,
AM.
divided by the predicted. Yeah. So if the actual is larger, it should be a number above 1, right? So it should be overvalued by whatever it is above 1.
Okay.
How can I measure growth?
Good question,
Sales.
Sam.
So I guess, so in the real estate, you can't really, there's no sales, I suppose. It's like
So this should be still revenue, right?
revenue.
Whatever they're getting the revenue from. So sales, revenue is the same.
Okay, so
Yeah.
percent of growth revenue.
Yeah,
Percent
now,
revenue growth.
For your sector, there are 3 good. Yours is kind of like Ethan's. It might be we talk a bit more about this later, but there are 3 popular measures in yours. Price to funds from operations. So you can look at growth in funds from operations. Price to adjusted funds from operations. You can look at growth in adjusted funds from operations. In fact, type that in. Type in FFO. And then type in
Oh,
growth.
there's
Yeah,
a
so
whole thing for it.
so growth, period on period, real estate, FFO. So you got it.
Huh.
And then the other is free cash flow.
Oh.
Just basic free cash flow.
Okay.
Could be used. Any questions so far in this?
Can you click on the predicted PDS press sales?
The
Uh,
formula.
For the formula?
I mean, the ones that I kind of hid up here?
No, just
Or-
like the formula that's
Oh.
used in the sale.
It's the linear formula. Yeah.
This thing right here?
Yeah.
Yeah. So remember, what I did is I named each of those coefficients in the regression output.
Yes, sir.
And then that made, otherwise I got to do that thing where I click on the cell that's got the coefficient and then lock it in with dollar signs. I just find it easier to do than naming.
Plus profit.
I was like, wait, it's not populating numbers, but then I realized it would only populate numbers for
Profit.
real estate,
Times.
not for Apple. That was cute for me.
Now, something I did in here that was kind of an oversight on my part, when I downloaded data from FactSet and had it in Excel, I've got all the real estate data in here, and I've got all the financial sector data in here. And since I'm telling Ethan and Sandon they probably want to do their own separate, it means they'll use just financial sector data and just real estate sector data, but it also means you guys don't want that data in your regression either. So you'll want to go back and redo this without the financial sector, without the real estate sector, but with the other 9 sectors. Now this gets to that question of, should I just do my own sector? Or should I use as broad a group as possible? So you guys have had stats. What happens when you increase your sample size?
Central limit.
It can be more accurate, right? Not necessarily, but it can be. It can reduce your p-values and make it more likely to get statistically significant results. But why wouldn't it? Because if you increase that sample size, you might be getting different sectors that are so different. They should be held out on their own, like say financials or real estate. And so that messes up your results. So you've got 2 things that you've got to trade off on. Increasing sample size increases statistical power as long as the sample comes from the same population. But if they come from different populations, if different sectors act so differently, it can actually harm your results. So financials are very different, real estate's very different, but the rest of you guys, all the other 9 sectors I'd say keep together.
And here's part of why. So let me show you. So let's go back into FactSet, and let's see how many companies there are per sector that are in this. Remember, I did a little bit of filtering, so we got about 1,300 out of 15. So in FactSet, if you click on this up-down arrow, and then click on Filter, there we go. It says that there are 260 financial firms. That should be plenty. It says 240 industrials. I mean, you could do, Brooks could do industrials on his own, but I would say industrials aren't wildly different from the other regular sectors, so keep them all together. More data would be better. You get some, though. I'll show you real quick. Let's scroll down in this list. Utilities, 57. That's getting kind of small. So I definitely would want to have all these companies in there. Communications, 49. So I definitely want to keep these all together, because what's going to happen, you might get good results, but it's less likely because you'll have a smaller sample size. So I keep all those together. Sandon will have 108. That should be sufficient to do a decent result for real estate.
Cool.
If it's not, maybe we'll lump it in with financials and see what happens.
What makes financials and real estate so different?
Most of the time,
Oh, I didn't log myself.
financials are just a very different beast. They, for example, for most of these other companies, for all the other companies, having debt increases risk. But for financials, debt's a resource to them. They lend back out to other companies. So they work different. Some of the measures that we use, like cash flow from operations, doesn't work for financials because that's not a well-defined term for them, but net income is. So for like communication services or staples or healthcare or tech or any of these other sectors, we could do all the metrics we talk about: price sales, price cash flow. We could look at all those things: operating margins, net margins. But for financials, EBIT is a meaningless thing. Net income does mean a lot. Return on invested capital is meaningless for financials, whereas ROE has very good meaning. So they're just different, right, in what goes into them. So we usually say kick them to the side, work on them separately from the rest of the group. Just keep them out.
So would tech not be included just because, not because it's like volatile, but just because it's measured the same way in sales as
Yeah, so tech
Staples
can work
and-
in there. Yeah, so
Yeah,
tech.
okay.
I mean, they should be growing at a higher rate and so forth, but they should be okay keeping them in there. Let's see. What else do I want to show you guys? We're not going to get everything done today, so I'm not going to try. I'm just trying to think of what I want to show you real quick.
The charts, how to take out outliers?
Say it again?
How to take out outliers? I don't remember how to do
Yeah,
that.
we'll do that. Yeah, so we've only got a few minutes left, and I'm not going to hold you guys late today, so we'll do that next Thursday. But we're definitely going to look at that, because that'll.
I forgot how much of those charts. That'd be nice to refresher.
Yeah.
Something I want to. So we're about to close out today. Like I said, we're going to do some more stuff with this next week, on next Thursday, after our visitor kind of comes and goes. So we'll have a smaller class time, but they should be more than enough to finish this up. What would be a good company?
For what?
Tornado Realty. We're investing in that guy.
The wow factor.
I'm kind of curious. Let's see. Let's find a company or two in here.
Probably something that's near the middle, but not crazy.
Let's see.
Neutrogena. Oh, NVIDIA.
Is that their ticket? I'm just kind of curious where they're at. So there's NVIDIA right now.
Oh,
let's see, they got a price sales of about 35, and it should be a little under 8, right? So they're trading basically 4.3. They're trading 338% of a premium over what they should be, right? So 3.3 times over fair value. Would you call NVIDIA a good or bad company? If you weren't even in here, like, or Apple.
Good.
Good company, right?
Yeah.
Products you like, things like that, right? So you know their name. But according to this, are they a good or bad investment?
Bad.
Right? So that's kind of the last thing I want to stress today, because it always is something that comes up. When you are doing this analysis, try your best, and it will not be easy to be dispassionate, right? Very dispassionate. When you're looking at prospective companies, and try your best to avoid including companies simply because you like the name, right? It's a hard thing to do for anybody, but it's something I want to stress because you guys are learning this for the first time in this kind of structured environment. Lots of times, you know, if you pick the good company, you might get a bit of momentum out of it, but you might well be paying substantially more than is worth. And it might work for a little bit, but it could hurt you in the long run. Just to show you guys, if you go on and do Google, you'll see a lot of this stuff. Do I not have it on here? Oops. There.
PKG.
Back at the stop.
On the screen. Let me pull up mine. I'll do it. Oh, they're on here. Lovely.
Yeah, so if you do, you can look up, you can go Google up price earnings versus future returns. This is what we're trying to do. You'll see better graphs than this. This was done in a hurry. And I went back way far. I went back to the mid 1800s. So I probably have data that doesn't work as good.
Interesting.
So if I cleaned it up, if I said, let's take it from, say, 1950 going forward, right? It's the past 70 years, roughly, 75 years. I might have had better data on here. But here's my data, right? So here's PE, high, low, and then the average return over the next 10 years. And it's not a perfectly linear relationship, right? There's a cloud here, but this is the regression line to it. You definitely see this right here. So X is the PE ratio. This is saying minus 0.0022X. So for every 1 point increase in the PE ratio, according to this, there is a 0.22% decrease in future expected returns. Right? So that's the basic premise here, is that if you pay too high a price, you are not guaranteeing you're going to get lower returns, but it's more likely you're going to get lower future returns, right? So that's the basic premise that we're working off of on this. It's kind of like going to a casino, and you're running stuff. You know that if you kept doing roulette or whatever one time, anything can happen, but you do it over and over and over again, you know what the averages are supposed to do to you. That's the same thing here, right? So we're trying to work on averages over time.
So you're saying when I go gamble, I should gamble many, many times in a row.
Yes.
Instead.
Even when you keep
51%.
losing, just keep gambling.
Because the next one will be.
Yeah, I'm gonna get my pink slip from this place. He told us to go gamble. That's what I got.
That's why I took the weekend
out
in
of
Shreveport.
Roundtable. I sold my car and my house, went gambling, and it didn't turn out good.
Dr. Jones told me to take the averages.
Okay, so we'll finish this stuff up next week.
Okay.
Right, and then after we do that, we'll start going more into fact set, looking at companies.